Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing a lot of macroeconomic drivers and dissecting all of the latest and recent data that we have had this week. Whether it's the PMIs, the services PMIs, the JOLTS data that we're going to be discussing. There's a lot of data that we're going to be incorporating into our analysis to try to give us a better macro overview of where we currently are and where we're likely going to head, because the stock market is kind of in this mixed place where you have a lot of data in contraction territory or making a downtrend, whereas the stock market is now making a new potential uptrend. So overall, what we're going to start off with is the PMIs here, the Purchasing Managers Index. And first thing I want you to notice is that we are making this beautiful consolidation trend below the 50 level over here. So really anything on the 50 on the PMI really shows signs of contraction, and of the 5 last consecutive months we have been below 50 for the PMI. So it's a decent chunk of time trending below, and as the PMIs have been heading lower here, you've actually seen the stock market make a bit of a divergence over here, trending upwards. And that is kind of a little bit of a rare phenomenon. Again, below 50, this little red dotted line demonstrates that the economy is weakening and certainly slowing. Now, the last time we had this many consecutive months below the 50 level was late 2019 over here, right before kind of our COVID decline. And what's interesting about this trend is you actually had a brief period here, basically right on this red line, where PMIs went below 50 and consolidated lowerly. Then they spiked up over here. And when they were actually trending lower off of that first initial dip below 50, you had the stock market trending up over here. This orange line below is the S&P 500. So there were several months where the stock market trended higher despite PMIs contracting. And then what initially happened, you had another spike above, and then PMIs just started to roll over, and that's when you got the bigger decline in the stock market, aka the COVID crash. Now, we have to be aware that there's other periods in time as well where if we scroll all the way down to say the 2008 period, in March of 2008 there were 7 months of PMI at 50 or below. So this is really where PMI started to contract in and around this February, March of 2008 period. And look what ended up happening. When you made that bigger contraction and started consolidating below this 50 level, you made one final surge to try to go back positive, but the stock market had a heavy downtrend following these PMIs. So what I believe is, yes, you get periods of time where PMIs really top before the stock market, like over here. We topped at around 61, and they kept trending down, making lower lows, as the stock market made higher highs. However, you reach that point where when you start consolidating below and under 50, and then you make that double top failure to recapture that 50 level, that's when bad things really start to happen in the stock market. So just definitely pay attention to the PMIs because they are a little bit of a leading indicator. Now, what's interesting about our PMIs is if we actually just scroll to the services PMIs, one of the reasons I actually think the markets are holding up better than most people are expecting is because of the services PMI. I really think the service side of the economy is keeping things afloat. If you look at the bigger companies in our world today, a lot of them are service-based companies, and I think a lot of the employment strength is coming from these service-based economies. And clearly service PMIs right now are holding up above that 50 level. So they are not quite in contraction territory. And notice how there's kind of a very similar trend with services PMI. So really, services PMI topped right over here at around 70 in May of 2021, made a big decline, kept trending lower. However, the stock market at the same period kept trending higher. It wasn't until the PMIs hit, or the service PMI hit around 57, where the stock market made a bigger fall to the downside. And then you can see they actually did briefly go negative, and then you had a little bit of a bounce. PMIs actually made a low around 43.52 in the service side, and the stock right before the stock market made a low. So the PMIs on the service side are actually leading. And the big question is here, we are still technically in a little bit of a downtrend since we've done this May high over here in service PMI. And right now we have made one higher high in the PMI over here, but this is going to be a big critical level. Can the service side of the economy pick up and recapture this 58 level, that's the big level. If we can, and if we start rolling over here on the service side, that's where there's going to be danger in the overall economy. And specifically, I think a lot of service-based businesses will be affected, and that's definitely been a strong part of the overall S&P 500 as we head forward. Moving along to the JOLTS data. So the JOLTS data identifies the measure of job openings. So what I'm going to do here, just to clean up the chart and make it easier, there's a few things we're going to compare. I'll erase that blue line there for a second. But this JOLTS data measures the job openings. And what we can see here in the green line is we peaked roughly in 2022, early 2022. And basically the JOLTS data has been coming down ever since. You made a high, a lower high, and you're making lower lows over here. Now, this is a long-term trend of the JOLTS data. It really only goes back to about January of 2000 or in the late 2000s. And you can see I've drawn this parallel range from the high here in 2000 to the low here in 2009 to another high here in 2018. You have a COVID low over here. And what you notice is that we've had a clear long-term range that we busted out of. A clear, massive breakout in the JOLTS data. And what this is telling us is that when we introduced low artificial interest rates and quantitative easing in the form of 120 million a month and 0% interest rates, the amount of job openings exploded higher. Now this could be for a couple of reasons. Why I think this exploded higher is primarily for two reasons. A lot of people ended up quitting, resigning due to COVID and just living off their stimulus checks. So that's one aspect as to why the JOLTS data exploded higher. And then the second aspect is there was a crazy amount of new positions and hirings that companies were kind of forced to do with the fiscal side of the stimulus and monetary side of the stimulus that they received. So you had those two dynamics that really caused this major trend in the JOLTS data to explode higher. Now the thing about the JOLTS data is that when there's a lot of job openings available, usually when these job openings start to decline, like we've been seeing since really the peak here in February of 2022, usually when the JOLTS data starts to decline, which is what we're in now, you start to see unemployment uptick. However, just because we're declining doesn't mean unemployment is going to uptick right away. I think it's really going to take the JOLTS data to get back to this pre-COVID high here, or even potentially the top of this channel where we mean revert. So roughly the level, the sweet spot where I think JOLTS need to revert back to the mean, we're currently trading at around 9.59 million. Once you start to get back in between the 8.2, so roughly around this level, to about 7.7, roughly this pivot high over here, that's when I think you're really going to see unemployment uptick. And now since we've identified what the JOLTS data covers, if we actually overlap the unemployment rate, so which is going to be this blue line over here, you can clearly see that the unemployment rate had that big COVID spike. Look what happened to the JOLTS data here, massive collapse, showing that there were less and less job openings, so therefore unemployment spiked. When there's less job openings, there's less people able to work. Now what we're seeing is the JOLTS data is still way above the mean, so therefore there's still, on a historical average, way more jobs available, which is why we're not going to see unemployment uptick as of yet. Now, JOLTS data can, over a 1 to 3 month period, make a big move down, which typically does lead the overall unemployment rate. So pay attention to the JOLTS, because if we get a big move down back into the mean trend, that's when you can start to see unemployment really start to uptick. But until we get back into that mean trend, I don't think we're going to see unemployment really make a substantial move to the upside. As of the latest unemployment rate last week, we're actually at 3.4. This chart says 3.5. So we actually made another lower low. But definitely pay attention to JOLTS, because once we get in between that 7.7 to 8.2 area, that's when you're going to see the unemployment uptick, and you're going to see the JOLTS data really start to fall substantially more. All right, let's move along to the next chart, which is the ADP employment change. So this is a measure of the private employment change. Now, there's been a clear downtrend since June of 2021. So if we look at the pivot high here in June, there has been a clear downtrend. High, lower high, lower high, lower high, lower high, lower highs. Now you're finally breaking out, and making a series of here's your low, here's your higher low, and here's potentially another little higher low. However, you still have way more lower highs than higher lows. So the trend is still down. However, it's trying to show signs of life. And right now, the big level I'm watching is the mean. If you look at the mean, the long-term trend, which is this blue channel over here, you can see you had a big move down, a big move out of the trend. This dotted line is the mean, sitting at around about 207, 204,000 jobs. Call it 200,000 just to make it easier. If you see the ADP employment change really start to break below this dotted line, that's going to signal additional trouble for the markets. And that's typically when you do start to see the S&P really start to roll over more. So the big trend over here was when the ADP really started to fall off a cliff here. That's when the S&P really started to make a bigger directional move down. You can also see it over here when ADP started to go negative below that 200,000 K sweet spot. That's when the S&P in 2018 started to really fall over as well. So there's a few different periods in history where you can really use the ADP numbers to your advantage because, again, they are typically more of a leading employment data set that often will be of high correlation to the overall market. And again, the sweet spot that I'm looking for is anything below this dotted line around 207 or call it 200K just to make it easier on yourself. So pay attention to the ADP because it is an important leading data point for the private sector. Let's move along to the next employment data, which is the ISM Non Manufacturing side. So the ISM is actually holding up still. However, one thing I want you to notice is we obviously put our major high up around 74 back in November of 2021. So that's pretty important to recognize. And since then, what have we been doing? Here's your main high, here's your lower high, and you just made a lower low in this whole trend. So what this is telling me is that the non-manufacturing side is weakening. And this is, again, another leading indicator that we have to pay attention to. I'm going to pop up the S&P 500, which is in orange down here below, and we're just going to work backwards through this chart. But first off, we're going to start during this period over here. This was your 2018 period. This was also a period known as the Powell pivot. But basically what we have here is the ISM non-manufacturing, so peaking roughly around this 64 area over here, maybe call it 65, 64.50. And you can see that it was clearly making a downtrend in the overall ISM. And basically what was happening was the S&P was making an uptrend. So as the ISM non-manufacturing was making a downtrend, S&P was making an uptrend. However, you come to this inflection point where ISM really started to roll over and you break that 50 bound area. As soon as you break that 50 bound area and really start to roll over and make a new low over here, that's when the S&P really started to roll over. And of course, this was your COVID crash. So again, this is kind of also a leading indicator because you can see that once the ISM started to roll over pretty drastically, that's when the S&P made a bigger directional move to the downside. Let's see if there's some more examples if we scroll through history. Again, what we notice first is you see a, let me just fix this S&P chart. You can see during this period in 2004, ISMs were making a downtrend as the stock market was making an uptrend. And then you look at this final breaking point where ISMs really started to weaken and go into that contractory period below 50, consolidating above there, crashing again, and look what happened to the stock market, the 2007-2008 bust. So pay attention, once we breach that 50 point and really start consolidating around it or below it, that could spell trouble for the overall stock market. Another period in the 2000s here is where you had the ISM peak. It pretty much matched the same peak in the dot-com bubble over here, where you had a big crash in ISM, and then you basically had a big crash in the overall stock market. Now if we pull it forward to where we are currently, you can see here on the chart that the ISM has basically made a clear downtrend, Now, you are making a lower low, so it is diverging from the overall S&P at this point in time. However, one thing I've observed and shown you through this cycle chart is that the S&P can diverge. As it did over here, you can see that we're roughly just trading below that level where we had in 2019. We're currently trading around the 52 level right now. But the S&P, it can't diverge for too long. Typically, history shows that once you breach that 50 barrier, that's when a bigger down move comes in the overall S&P 500. So again, a lot of data is just hanging on a cliff. The service side is holding up. The manufacturing side is weakening. This non-manufacturing side is weakening as well. But it's really a lot of the leading economic data is starting to point to lower growth, which is very, very concerning considering our market is primed and heavily weighted with growth stocks. Now let's move along to the Fed fund rate. Obviously everyone knows the Fed raised. We're now in the target range. This chart is a little bit delayed. The Fed fund rate is actually in the range of 5 to 5.25%. So it's actually a little bit higher, and it's roughly in line with this 06-07 period. We're at these highs. Now, one thing I want you to pay attention to is obviously we've had the stock market when we've gone on this, the Fed's gone on their interest raising phenomenon. The stock market had a big sell-off. Now that we're getting close to that Fed potential pivot or potential pause in hiking, maybe they don't just start cutting and lowering, maybe they just pause here. Typically when the Fed starts to cut and pause as seen down here, that's when you get a bigger move down. As seen by also here, the Fed starts to pause and cut and you get a bigger move down in the stock market. There are times in the stock market over here where the Fed is raising and the stock market rallies. And why I think we've seen a decline sharply as the Fed is raising is because in predominantly a lot of these other scenarios, at least in the 07-08 and the dot-com bubbles over here, basically over here, the Fed was raising, the stock market was rallying. The reason this is different is because 2000 and 2008, we really didn't have much inflation. So it was difficult to compare to, but needless to say, if you blow up these charts, you can clearly see the bigger declines typically come when the Fed starts to cut and lower rates. Okay, so let's just pay attention to when the Fed officially starts to pause, because that might be the signal for the bigger move down. You may have a 1 or 2 or intraday week rally, but again, at some point in time, that Fed pause, that Fed cut starts to really get priced into the economy as a recession. And we have had a meaningful bounce off of the lows. So that kind of matches up with the periods when the Fed is raising, the stock market can continue to rally. And now the big question is the Fed going to over tighten? Is inflation going to come back? Or are they going to start to pause? And is that when the market starts to price in a recession? But history does show, the probabilities dictate that when that inevitable Fed pause comes, you can see a bigger move to the downside in prices of equity stocks. Let's move along to the next chart here. So the next chart is going to be the initial job loss claims over here. So the initial job loss claims measures the number of people who filed for unemployment income. Now, one thing I'm going to tell you is that the markets are kind of in a sweet spot right now. However, there are periods in this history where you start to get above, say, the 250K or lower is really the sweet spot for the market. So right now you can see the markets are kind of in a sweet spot for the initial job loss claims. They have been in a sweet spot really since roughly around this candle over here, October of 2021, October, November, the initial job loss claims have been in a grand sweet spot for the markets to trend higher. Now the big thing for initial job loss claims is that they can all of a sudden spike and surprise people to the upside. Obviously COVID was more of a one-off event, but once you start trending above the 250,000 level, which right now we're at 242, so not that higher, that's typically when the markets have a little bit more of a meaningful reaction to the downside. And really once levels start to get breached above this 300, 320 level, that's when equities have a very, very negative move to the downside. So what I'm going to show you here is there's a couple brief points in history where basically you can see that once we start getting a meaningful trend of surprises in initial job loss claims, equity markets tend to sell off over here. Big spike to the upside during COVID, big drop to the downside. Let's move along to another cycle over here. You can see that equity started to, initial job loss claims really started to gain momentum to the upside, trading well above the 300,000 level, and look what happened to the stock market. Boom, a big decline in the stock market. Over here in the 2000 bubble again, you started trading above this white little trend line, above the 300,000, gaining an uptrend, and the stock market had a big sell-off to the downside. So there's periods in history where initial job loss claims really start to spike, and it does cause dips in the overall equity market. So anything above 250, you really want to start paying attention to. And specifically when you start building a multi-month trend, that's when things could get a little out of hand for the equity markets, because inevitably liquidity, the stock market moves up on liquidity, and if job loss claims rise, that is a sign of the economy running out of liquidity and potentially going to run out of liquidity in the future, because, or at least it's going to have slower and lower liquidity, because if people don't have jobs and they're filing for insurance, it means they're not going to be able to spend as much, they're not going to be able to buy and consume as many goods and services, so they're going to have to cut back on their lifestyle spending. So right now we've seen 3 months of an uptrend forming in analyst expectations being beaten on the initial job loss claims. So again, this is kind of a new trend that is I'm watching very closely. I would love to see a fourth potential month to confirm this potential trend, because one thing about the job loss claims is when you start to get those 3, 4, 5, 6 months or a couple quarters of trending to the upside, that's when equities again start to have a reaction, more cases than not, to the downside. So just be wary that initial job loss claims are putting in a small little formation of a trend here. Really, we haven't seen that for now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 months here since initial job loss claims have really been in a clear downtrend. And now we're starting to peak above this 12 or this 13-month consolidation trend where initial job loss claims have been fairly muted. So we'll just pay attention to that very closely. Let's move along to the non-farm payrolls. So non-farm payrolls are the measure in the change of the number of people employed during the previous month. So the non-farm payroll is starting to form a small downtrend. Obviously, we have our crazy COVID outlier high. We had a big sharp move down to the downside. We actually went negative. Then we bounced back to the positive above the pre-COVID high. I have this white trend line here sitting around 330,000 as the pre-COVID high. That's kind of your baseline before we started that's your high baseline before we started the QE and zero rates. And then obviously you have zero as your zero boundary contraction point. So right now we can clearly see that you had your high, you had your down, big move down, you bounced, you made another little low here, bounce, you couldn't take out that high, made another little lower low, bounce, couldn't take out the high, pierced the high, made another little lower low, and now you're trying to form a little bit of a 1, 2, 3 lower lows over here, forming another little downtrend. If the non-farm payrolls can't get above this 330 level and it gets rejected there, which I think is very likely, and we start heading to the low end of this range around the zero bound mark, that's not going to be good. That is not going to be good for equity prices, because again, once the non-farm payrolls start to increase, it's generally a sign of the overall labor market weakening. And definitely pay attention to the non-farm payrolls, because again, they're leading and they have a high, heavy correlation to the overall S&P 500. Noticing from the high here on the S&P 500, you topped in around the end of December or the beginning of December over here, 2021. Look where non-farm payrolls were. They were really still above that 330 level. And then you had a big spike which caused the S&P to get a little bit of a rally here. Then you had a bigger drop from this over this 900,000 level down to the 250. The S&P fell pretty sharply. Then you had another little spike in non-farm payrolls, which caused the S&P to spike here. Then you had another final little drop over here in non-farm, which caused the markets to drop. And now you're still making a little bit of a lower low, but the S&P has kind of diverged and starting to push up. Again, if this pierces the zero bound mark or goes negative or even makes another little lower low in this trend, the S&P is likely going to see some weakness. You may not take out the low right away, but you could be testing these major pivot zones on the S&P. We're calling 4,000 and then around 3,800. So pay attention non-farm payrolls, because they are another leading indicator. Now the final chart that I'm going to show you is the GDP. GDP is one of the more important conditions that I like to follow because it does give you a good sense and it really backs up the overall trend of the market in most cases. Now GDP, this chart is a little bit lagged. It's showing at 1.6% here. Basically that was at the January. As of the beginning of the month, May, GDP is actually at 1.1%. So right along this green dotted line over here. Now, as you can see, once we contract, when we enter these contractory periods, that is super detrimental to overall equity prices and growth stocks. And a lot of sectors do respond negatively to GDP before other sectors. For industrials, for example, industrials have a tendency to respond to lower GDP. But what I want you to pay attention to on the S&P 500 again here is, notice how GDP peaked up here. Look at the exact peak in the stock market. Then you had a big decline down, and the stock market had a big decline down in the S&P 500. Now, the S&P 500 is trading all the way at that 4,100 level. Let me just pull up the exact S&P measurement here. So the S&P on the daily chart is trading at 4136 on the SPX, so actually at that exact level. And what I've noticed is that from this 1.6, we've actually gone down to about 1.1. So we've made a little bit of a negative divergence where GDP's declined a little bit, but the S&P has continued to go up. So are we going to see a potential where if the GDP continues to decline, is the S&P going to continue to grow? That's very unlikely. Which is why we have to pay attention to GDP, because again, that is ultimately going to be the biggest economic factor that drives growth. If, again, for on a fundamental valuation of stocks, when you have GDP declining or contracting and being revised down substantially, I mean, at the beginning of May, the GDP now, Atlanta Fed GDP now was sitting at around 2.2, and then by the end of the month, they revised it down to 1.1. That's a cut. You're cutting GDP in half in 1 month span, but yet stock markets are trying to break out and push higher highs. That's typically never ever a sustainable move in stocks when you have stocks leading and the GDP lagging. So pay attention to GDP because we are trading at that 1%, and if GDP contracts like it did in COVID, like it did in 08 over here, I mean the stock market is going to have a bigger move to the downside. And typically they do move together, and considering that stocks are now diverging from the GDP, that is not signaling a sustainable move to me unless the GDP data is being calculated wrong and unless the statistics that we're getting from the Bureau of Labor Statistics are not quite in line with what they are reporting. But we have to go with what they're reporting as of now, and obviously there's a big divergence in stocks. So to sum things up, the main important ones are going to be JOLTS and the ISM and the services PMI. The services PMI, I believe, is what is keeping this economy up right now. And if the service PMI really starts to, and the ISM really start to weaken a little bit more, that's when we're going to start to see things fall off to the downside. But definitely pay attention to the services PMI, because when you have the regular PMIs contracting, when you have the non-manufacturing PMIs almost contracting, it's naturally and eventually likely going to bring the services PMI down, which is then what's going to create a little bit more of the job losses to the JOLTS data to start to decline, which is inevitably going to start to spike that unemployment rate. But again, until that JOLTS data starts to really come into the $8.8 million level, reverting back to the mean trend, unemployment is really not going to rise, because you still have a way above average of jobs available and job openings available than your historical 20-year trend over here. So there's a lot of moving dynamics, which is why the markets are very, it's at a tricky inflection point, because you are getting leading data sets that are signaling one thing, but you're also getting lagging data sets that are signaling another thing. Eventually, a lot of the economic data does make sense, but once the majority of the data hits into that contractory territory and reverts back to the mean, that's when the stock market is likely going to see its next down leg. As of now, respect the trend. Stocks can float a little bit higher. They are diverging from key asset and key data sets, but it doesn't usually last a long time, that divergence. Thank you all for tuning in. Hope this video was helpful on the macro front. It is a little bit more dry than just charting and talking about stocks, but a lot of people are very confused about what data sets to watch, and hopefully this video has been a little bit of informative as to the different data sets, what they mean, what the trends are, where we are, and where they're likely to go. Thank you all. Please give this video a big like down below, subscribe, and don't be afraid to check out our website where we have a whole host of other plethora of information and how this macroeconomic data can be applied to actionable trading and investment insights. Take care, everybody, and we'll see you on the charts a bit later.